Okay, I think we should make a start at that point. So, good afternoon, ladies and gentlemen, and welcome to this afternoon's repeat of this morning's IFRS webinar. At this end, it's me, Ian, and online we have Joe and Andrew from London office, Livan Papiashvili, whose surname suggests to me he is Georgian by origin, Carolina Maldonado, and Raul Fernandez. Debbie Hensman has just joined us. Debbie, if I remember correctly, is in Canada, on Toronto, I think, if I remember correctly. And we still have one person, David 1, who is struggling to get his sound activated. So let's therefore just put that message up one more time and see if that helps David to get his sound activated. Usual rules for interaction, please make use. That's right, Carolina, your microphone has been muted by me, deliberate. We've discovered over the years that if we have the two-way conversation by my microphone and yours being open, it reduces the bandwidth from the broadcast. And everybody then gets a poor reception. So there's a nice little control that I have that enables me to mute everybody's microphone upon login. Okay, thank you, Debbie. Okay, so David is with you, David 1. Okay, cool. Yes, in theory, we've got two-way conversation. In practice, we tend not to use that, unless right at the end of a webinar, there's 2 or 3 people who want to debate something, and that's quite possible. Use the chat box, or alternatively, the Q&A box. They're both equally available to me. I have 4 polled questions during today's webinar to keep you on your toes and test out your understanding. Now, a word of warning, you will need a calculator or a spreadsheet or something similar, a mobile phone. You will need a calculator for 3 out of the 4 questions. This morning's webinar indicated that as soon as numbers were involved, somehow we accountants started to struggle. So 3 questions that will require a calculator of some sort. And of course, I'm always delighted to hear from anybody after the webinar. So this morning's webinar took just exactly 2 hours. So I'm expecting something similar today for this afternoon. The subject matter is IFRS 13, the Fair Value Measurement Standard. And we'll be covering that standard together with also, towards the very end, a brief commentary on the IASB's plans for some amendment to IFRS 13. Also, at the very end, I'm going to just spend a minute or so to alert you to a very recent publication from just middle of last week. IFRS 23 is now published and going to be required from the 1st of January 2019. I am recording the webinar. Important, I forgot to do that this morning. And so your colleagues and any of you who want to relive the moment will be able to do so with a recording. Okay, so IFRS 13, fair value measurement. Now, this was an important development in IFRS standards. Immediately before this standard was published, there were about 4,600 references in the standards to fair value. 4,630 something, if I remember correctly. And there was no agreed definition or methodology for calculating fair value. A pretty major hole in the gap. Not only was the IFRS standards deficient with a fair value measurement, but also the Americans had already implemented their version of fair value measurement, and so we were running a little bit behind the game. So IFRS 13 was an important development. I've got a single slide of a couple of points of introduction, a summary over 2 slides, and then we'll get into the detailed requirements. And it's during the detailed requirements that I have these 4 polled questions for you. But then right at the very end, I can tell you what the IASB are planning in terms of amendments to this standard. And as I promised, I'll also just give you heads up on the newly published IFRS 23. So the standard was issued in order to simplify existing guidance. That's because in a few standards there was a description of fair value. Sometimes the description was directly opposite other descriptions. That wasn't very helpful. And obviously, therefore, there was a lack of consistency. Many standards use the term fair value without any indication as to how it should be measured. So it was issued to simplify and to achieve consistency. Second aspect of the background, of course, was the financial crisis of 2007, 8, 9. Well, I don't know, some people would think it's probably still going on. G20, the group of 20 nations, were very clear in their analysis after the event of the financial crisis that there needed to be improved disclosure about fair value and the fair value methodology. Thirdly, we needed an equivalent to US GAAP IFRS 257, I think it is. For some time, codified within US GAAP requirements, had been a comprehensive fair value measurement standard. And we were running behind the game on that score. And so IFRS 13 was published around the end of 2011 for a mandatory effective date for accounting periods commencing on or after the 1st of January 13. Now, there's been one tiny clarification amendment since then. So the version that I'm going through with you today is the current version. And as I hinted, there are some plans for very minor amendments sometime in the next year or so. Now, it's sometimes challenging to try and summarize these IFRS standards. Some of the larger standards cannot, frankly, be summarized in much less than 3 or 4 slides. This one, I can summarize it in 2 slides. So, the standard does not change the subject matter. In other words, what is it that might be a candidate for fair valuing? That's quite important because when IFRS 13 was being developed, there was a degree of concern within Europe that this might be a further attempt to extend the range of fair valuing. No, that's not the case. It is other standards that tell us what might or have to be fair value. This standard does not change that scope, in a sense. IFRS 13 also does not change the moment in time when fair value may need to be obtained. Now, clearly, in many cases, fair value is something that is looked at as being part of the year-end process, particularly when you're fair valuing, say, equity investments held. But there are other occasions in the year when fair value might be needed, particularly, of course, in the event of a business combination under IFRS 3, when you have to fair value the price paid and fair value the net assets that arrived with the deal. So IFRS 13 does not change when a fair value is needed. There are, in fact, other occasions when a fair value may be needed in the middle of a period. For example, when there is an indication of impairment under IAS 36, or equally when, in the context of interim reporting, there is an asset held for sale under IFRS 5. So, the standard does not change what, it doesn't change when, and perhaps from a deeply conceptual point of view, it does not change the reason why fair value may in fact be a relevant or indeed even perhaps the most relevant measurement attribute for assets or liabilities. So IFRS 13 doesn't change what, when or why, it changes how. It changes it in the sense that before the standard nobody knew for certain how it should be measured. In fact, what tended to happen, if anything, was that in the context of IFRS application, people borrowed from US GAAP and used the US GAAP SFAS 257. So IFRS 13 changes the methodology. It standardizes it. It also, of course, changed and indeed extended the disclosures that might be necessary about fair value. So, the standard defines fair value. We'll see the formal definition in just a couple of slides' time, but for the moment, it defines fair value as an exit price. Now, that's an exit price in the sense, therefore, of selling an asset, or it's an exit price in the sense of transferring an obligation, a liability, to somebody else. Now, how might we ascertain a fair price for something? Well, the answer is, of course, in many cases, you will do it by referring to the data in a principal market. And there's a principal market for many financial instruments. So let's say that you're looking to fair value, say, some quoted shares or quoted bonds. If you're here in London, you'd look at the pink newspaper, the Financial Times. If you're trying to fair value, say, some metals, then it's probably a fairly safe bet that your principal market to refer to would be the London Metal Exchange. If you're trying to fair value coffee or sugar or cocoa, then you might, for example, access the marketplace at CBOT, Chicago Board of Trade, and there you will find your evidence. So ideally, we identify fair value by referring to pricing information obtained from a principal market. But of course, the problem is not everything that needs to be fair valued will have a principal market, particularly when you think in the context of acquisition accounting, where the target company brings to the table buildings, warehouse, machinery, equipment, motor vehicles, items of inventory, and so on. And very few of those, perhaps, will have an obvious principal market from which to derive pricing data. So in many cases, we will, in fact, be, if you like, hypothesizing what a fair value will be. And we should do that, it says, by assuming that a transaction that would take place between arm's length, independent, knowledgeable, able, capable, and indeed willing. They're not under any sort of pressure or duress. Independent, knowledgeable, able, and willing market participants. So when we get into the detail of the requirements for this standard, we'll be looking at fair valuing by reference to a principal market, and then we'll be looking at the alternative where no principal market can be identified. Some of you will realize, therefore, that if we are unable to identify a principal market, a Financial Times type document, then we are likely to be making use of models, valuation models, which of course need inputs to enable them to predict a value. And the standard is very clear that the use of models with inputs should be maximizing those inputs that can be verified, that are observable. So, for example, it may be observable to find a company's credit rating, and that could be, therefore, a valid input into measuring, say, the fair value of any issued bonds that company has. So, maximizing the use of observable inputs and correspondingly, therefore, minimizing unobservable inputs. Now, that raises, therefore, a risk attaching to the fair value estimate. And so the standard introduces, it rehearses the fair value hierarchy disclosures that many of us will remember first appeared in IFRS 7. They now rest in IFRS 13. So we talk about level 1, level 2, and level 3 fair value hierarchy. Okay, we're now going to get to grips with the requirements of this standard. Now, that's going to take us on a journey through, firstly, scoping. So what is in scope and what is outside of the scope of the standard. Then we'll be able to look at the definition of fair value and how the standard then describes the identification of a principal market, and most importantly, because it's quite practical, what are we going to do where there is no principal market that can be identified? The standard comments on the characteristics of market participants and then leads into the fair value hierarchy. It then talks about acceptable valuation techniques and inputs to valuation models, a couple of specific measurement issues, and then finally the disclosures, which I'm not going to go through in any depth with you. Disclosure requirements are always best addressed by, of course, making sure you've got an up-to-date checklist with you. So, firstly, scope. Now, IFRS 13 applies when other standards demand or allow fair value. So, back to my initial comment by introduction, this standard does not extend the range of items that need to be fair value. It's other standards that will introduce a requirement for fair value. And that's fair value being measured possibly for bookkeeping purposes, okay, initial recording, subsequent recording. It's also fair value where it may be used as a disclosure requirement. So 3 very specific points with examples. A requirement to use fair value for measurement would be, for example, assets, financial assets that are carried at fair value through profit and loss, as required currently by IAS 39 for one category, and will equally be a requirement of the new IFRS 9. Secondly, this standard will apply when there is a permitted measurement basis. So, as I'm sure some of you know, under IAS 40, investment properties should have a choice of accounting policy, either at historic cost or at fair value. And so there, fair value is a permitted measurement choice. And if you were to choose a measurement basis for investment properties at cost, then, third point, IAS 40 requires the disclosure of that fair value. So IFRS 13 applies when either there's initial or subsequent balance sheet accounting. Some things absolutely required, some where it's a choice, some where it's a disclosure. This standard also applies when there is a measurement that kicks off with fair value. And of course, a classic example of that, I mentioned earlier, is when under IFRS 5, there are non-current assets held for sale, where, of course, the correct carrying amount under IFRS 5 is the lower of the book value or fair value less cost to sell. So IFRS 13 applies in that circumstance. So there are only 1 or 2 very limited exceptions to the use of this standard whenever the phrase fair value appears. So scoped out are share-based payment transactions under IFRS 2. IFRS 2 comprehensively describes how to fair value in different circumstances, share and share option type plans. Also scoped out are the references to fair value that you find either in the old leasing standard, IAS 17, or indeed in the new leasing standard, IFRS 16. And there, the references to fair value occur particularly in the context of sale and leaseback transactions. This standard does not apply to measurements that are similar in nature, but are not fair value. For example, the estimation of net realizable value for items of inventory, or the measurement of value in use in the context of IAS 36. The standard applies for measurement, but not disclosure. So there are disclosure exceptions, 2 of them that relate to pension plan accounting, IAS 19 and IAS 26. And then under IAS 36, the impairment standard, where the recoverable amount may well be fair value less cost to sell, then it's IAS 36 disclosures that kick in, rather than these IFRS 13 disclosures. So there's the first part of our journey of requirements, scoped in and scoped out. Now, clearly at the heart of the standard is the definition of fair value. A price that would be received to sell, okay, an exit transaction, or equally, the price that you have to pay to transfer an obligation, a liability. Again, an exit transaction. In an orderly transaction, meaning therefore a transaction where both parties have had time to understand the transaction, determine whether they are willing, knowledgeable, arm's length, and so on, between market participants at whatever measurement date is relevant. And it's not my work, but it is straight out of the standard, where it then says in brackets, i.e. an exit price. Now that's itself important, because before this standard, there were some descriptions of fair value that seemed to be an input cost. There were some descriptions that seemed to be an output value. And incredibly, there was one description of fair value which was both an input and an output value. And you sort of think, well, how does that work? So this was an important clarification. Some points that follow from that. Fair value is not the way a particular entity sees it. It's an out there value. It's a market value, if you like. Although one has to be careful describing something as a market value, because not all items will have an obvious market. The point is that it's not the way that an entity sees the value, it's the way the world out there might look at it. And so the focus in determining or estimating fair value is on market participants' assumptions. What would they be concerned with? And so it follows that if market participants would say, Ian, where is that building? And you say, well, what a very sensible question. If market participants would ask that, then it is relevant to you, a financial statement reporter, a preparer, when estimating fair value. Equally, of course, somebody might say, Ian, where are those bonds? And the answer is, well, the location of those bonds is probably completely irrelevant. What are you asking me? So some assets, location, condition will be of relevance. On the other hand, if we're thinking about bonds, where someone says, Ian, are there any restrictions on what I can do with those bonds? I mean, it might be, for example, that the bonds can only be sold back to the person that you bought them from. Now that, again, is a highly relevant question. So, look at the bottom note. If participants would consider asset characteristics, such as location, condition, restrictions on use, and so on, when they are determining a price of an asset or a liability, if market participants would do that, so also should the preparer, the reporter, when they are estimating fair value. Now, we'll come back to that very important point with some examples in just a few moments' time. The standard points out that fair value may be something that is determined for a single standalone asset, liability, or indeed it may well be relevant for a collection of assets or liabilities, or even a collection of net assets and liabilities, typically, for example, a cash generating unit. The standard makes the point that in all cases, the unit of account, single asset, single liability, collection and so on, is determined in accordance with the standard that brought you to this position. Okay, IFRS 13, other than just a couple of very minor exceptions, IFRS 13 has nothing much to say about the unit of account. It's the standard that brought you to this point that will tell you, are you measuring a single asset or a collection of assets? Again, perhaps in the context of, say, assets held for sale. There's a very particular exception in the context of commodity trading, trading in sugar or cocoa or something like that. The transaction that we are going to be looking for in terms of a physical transaction to provide absolute evidence as reported by a pricing system like the Financial Times, or equally the transaction that we might have to hypothesize if there's no observable market price, assumes a transaction taking place in an orderly manner. Now, Appendix B provides some guidance on whether or not circumstances may, in fact, indicate that a transaction is not orderly. Now, an orderly transaction implies that the market participants are properly independent, knowledgeable, willing, that they have been given sufficient time to market the item, they've been given sufficient time to consider whether to buy. I mean, that's orderly behavior in a marketplace. Some of you might even like to sort of think back to your economics studies of the sort of definitions of a perfect market. Large number of buyers, large number of sellers, no one person can affect the market, perfect information, minimal transaction costs, and so on. These are the characteristics that identify a transaction as being taking place in an orderly marketplace. So the standard says, firstly, just because there is thin activity in a particular market compared to what would be normal, does not instantly mean that everything you observe is disorderly, not orderly. I mean, it might suggest that possibility. It certainly means that your examination of the circumstance needs to be a little more involved and circumspect. But just because activity is reduced compared to normal does not instantly mean that all observed transaction prices are shaky in some way. The characteristics of transactions that would make me think that there is not an orderly market would be, for example, where something is being priced based on a completely inadequate marketing timetable. Or perhaps the usual marketing period was available, 3 months, but the seller just kept approaching one single participant, perhaps with a degree of pressure to close the deal. Maybe it's because there is some sort of impending crisis. The seller is in or close to a bankruptcy or a scheme of arrangement. Maybe the seller is obliged to make a quick sale in order to meet regulatory, for example, central bank processes. And to use an American expression, whenever there's an observed transaction price that seems to be right out at the extremes of what would otherwise be the sort of central pricing, Americans call it an outlier. Whenever there is an outlier price, it raises the question whether that observed price is derived from orderly transactions. Interesting area, a challenging area for us as auditors, and quite a significant judgment to be exercised as to whether an observed price is that derived from an orderly market? Now, in many, many cases, fair value will be pretty obviously measured by reference to pricing data from the principal market. I mean, if you're a company here in London and you're trying to place a value on some quoted company shares, what would you? You'd look at the pink newspaper, the Financial Times. What else would you do? Similarly, if you're trying to value, say, some metals, copper, zinc, tin, you'd almost certainly have access to the London Metal Exchange, and you'd use that sort of information. So, the standard presumes a sale or liability transfer taking place in the principal market. Now, of course, where there are principal markets for assets, there are less obvious principal markets for liability transfers, other than perhaps, say, particularly in the insurance sector. So what is the principal market? It's the market that demonstrates the greatest volume, level of activity, and quite importantly, depth of liquidity. A principal market is one that when you approach it, you will expect to be able to transact there and then, rather than perhaps being told, come back in 6 months' time and I might deal with you. So a principal market is the London Stock Exchange, the Frankfurt Stock Exchange, CAC 40 in Paris, CBOT, the Chicago Board of Trade, or equally the Singapore commodities market. They're fairly obviously principal markets. But not everything has a principal market. When you make an acquisition of a company that brings with it brands, know-how, machinery, equipment, customer lists, and so on, you say, well, hold on, there is no market. You don't phone up the London Customer List Exchange and get a price. So you say, well, my goodness, I'm going to have to hypothesize what that price might be. So, when there is no principal market that can be identified, then the standard absolutely demands that you identify the most advantageous market, and you use the data from that process. The most advantageous market is defined as the market would maximize the amount received or correspondingly minimize the amount paid for a transfer and obligation. The best price, in other words, the best, after taking account of both transaction and any transport physical type costs. Now, you might say, well, Ian, does my client have to do a Google search for the global markets for potatoes to find the most advantageous? No, definitely not. The standard does not require an unreasonable amount of effort in identifying the most advantageous markets. Simply those markets that are accessible, readily accessible for your clients. Typically, therefore, there'll be 2 or 3 local markets that they might be able to go to and sell, for example, their agricultural produce. Let's have an illustration. There are 2 markets for the sale of an asset. Imaginatively, market A and market B. We're told that there are selling prices of 26, 25. Transport seems to be relevant. Okay, so these are clearly some sort of physical asset that has to be taken to market. And as we know from our earlier slide, if a participant was to say, Ian, where are those items? and you say, well, yeah, they're in Timbuktu, then it's an entirely irrelevant question and an entirely irrelevant cost to deduct transport costs. And so you can see my subtotal used to actually measure fair value. But in order to determine the most advantageous market, you also need to identify the transaction costs of approaching that market. And so we've got two bottom lines of 21 and 22 respectively. So consider company X that holds this asset, and for whatever reason, it needs to identify its fair value. Circumstance 1, X identifies market A as its principal market, in which case the fair value of the asset is, see it there, 24, used to determine fair value, a selling price minus a transport cost, assuming that transport is a relevant characteristic, or location is a relevant characteristic. Circumstance 2, X says, I have no idea which of these could be considered a principal market, in which case X must identify the most advantageous. In other words, the market that would maximize the net proceeds after all of the costs of approaching that market. And clearly, the most advantageous market is market B, giving us a net 22. But 22 is not the fair value. The fair value is 23. Okay. Let's put it another way. This standard defines fair value, not fair value less transaction costs. It defines fair value. Now, other standards might tell us what to do with any transaction cost, but your starting point, fair value, will be after any location or restrictions of use type adjustment, but before any specific transaction type fee. Now, armed with that knowledge, let's present the first of today's poll questions. So at the 31st of December, X holds an inventory of 150 new and identical items. There are 3 different markets in which these things can be sold: market Alpha, Bravo, Charlie. And I've given you in that table information about the selling price per item, the transaction costs per item, which are not very expensive. I know you sell for 40,000, transaction costs 200, 400, whatever. And I've also told you about the transport cost of getting this item to the appropriate marketplace, Alpha, Bravo, or Charlie. Now, you will need that information to answer the question, so I will flick back to this screen in just a moment. What I need you to do firstly is to say, okay, there is no information given about principal market. So let's say that there is no clear principal market. In which case, my simple question to you, what is the fair value of those 150 units? And you know from our previous illustration that that means we need to discover the most advantageous of these markets. So I'm going to flick between these 2 screens. I'm going to open the polling panel on your desktops. You should need a calculator. What is the fair value of these 150 items, given that there is apparently no determination of the principal market? The choices that I'm going to give you are 5910, 5895, 5940, and 5955, A, B, C, and D. Now I'm going to shut up and let you work with your calculator. This morning we gave everybody the full 5 minutes to work this out. Once again, those are the choices that I'm offering you. We've got 2 answers so far from the 8 of you. Well, Joe is excused, and I expect Andrew also. Both of them were attending this morning as well. So 150 items, you need to identify the correct fair value based firstly on determining which is the most advantageous market. Those are the choices I'm offering you. One of them is right. So we've got half of you have responded so far, 4 of you. The WebEx system is time limited to 5 minutes maximum for a polled question. And we've got somebody who's just about to answer. And then I will be happy because that will take us to more than half of you have responded. Well, there are 2 of you now who are about to respond. That's excellent, thank you. Okay, the question will close automatically in 15 seconds time. So if you want to make a response, you've got 10, 9, 8, 7, 6, 5, 4, Okay. Well, that's quite encouraging because there are 4 of you. That's half of you. That's brilliant. And bearing in mind that there are 2 who I'm not expecting to respond because they were with me this morning, that is 4 out of 6 who have responded with the correct answer. So I'm very impressed indeed. The correct answer is, of course, C. And I'll now just provide you with the explanation. There's a descriptive explanation, which we've already covered. Okay, we know it's an exit price, a presumption that you would try and measure it in a principal market. Where there is no principal market, then you need to identify the most advantageous. We know that that is the one that would maximize the bottom line, or equally, would minimize the price to pay for someone else to take an obligation away from you. And that is after transport and market transaction costs. But fair value is not adjusted for the transaction cost. And so there is your working. One of you selected 5910. You're nearly there. What you've done there, of course, is to use the 39,400 figure for fair value, rather than going back up to the subtotal 39,600. So market alpha is the one that would maximize the amount received for sale. So the fair value of the items, 150 items at 39,600. Well done to 4 of you who got that right, and 1 of you who was very close when you selected answer A. Okay, now moving on with the same circumstance. The following further information is now provided. And very deliberately, I've given you information about X's own activity within each of these markets. And I've also given you information about the market in its entirety. And I haven't told you yet whether or not you measure a principal market by reference to an entity's activity level, or do you measure it by reference to the market in its entirety? I think it should perhaps be fairly obvious. So, given this additional information, which now will enable you to select which is the principal market, my question again is, what is the fair value of the 150 units? And again, I've opened the polling panel for you. And to make it a little easier for you, I will flick back to the previous slide. There's your workings for all 3 markets. I just need you to determine which one would be considered the principal market, given this additional information. Okay, there's the additional information. Here are the 3 tabulations from earlier for those 3 markets, for the unit and its transport costs and its transaction cost. So, which market might we identify as principal? And following from that, what is the fair value of the 150 units? Somebody's got it right already. Okay. There's the information about the markets, Alpha, Bravo, Charlie. There were our tabulations of the market price, transport cost, and transaction cost. I have deliberately not put a description to the subtotal. You need to think what that is. So, which market would be identified as principal, and therefore, what is the correct fair value? Let me just go back one more time to the tabulated data. So when we had no identified principal market, then alpha was identified as the most advantageous. Now we've got some information about the markets. So the question is, with that, can you identify the principal market, and therefore what is the correct fair value of the 150 items? Well, again, the system, WebEx system, is nearing the point when it will close the poll. 20 seconds left. And I think we will close the poll at that point. So we've got 5 out of 8 of you have responded, and very encouragingly, from those 5 of you, 4 of you have got it absolutely right. So I'm very impressed. The correct answer is D, 5955. So well done to 4 out of 5 of you. The explanation: the principal market is the one with the highest volume and level in total. It's not based on an individual entity's exposure to that market, but rather to the total size particularly, but also, I mean, some judgment might have to be entered into it, where there are questions about the depth of liquidity, say, in a particular market. In many cases, I used this illustration this morning, in many cases, if there is a principal market, you'll find the phone number programmed into the company's telephone system, because it's what they would typically pick up the phone to buy or sell, as the case may be. So, market Bravo, based on the total size of the market, is the principal market, and therefore the fair value is 150 units at 39,700. 5955. So well done to 4 out of 5 of you who responded. It's time for a short coffee break, and then immediately after coffee, we'll go. We're more than halfway through now, and we are, in fact, 30 seconds ahead of where we were this morning. I'll see you all in 5 minutes. Okay. Sad fact, but a 5-minute interval doesn't last more than 5 minutes. I hope, though, you were able to just refresh yourself. So we've got 2 more polled questions, and they're coming towards the end of this second half. So we now need to see what the standard has to say about the market participants. And it's quite simple. It doesn't require you to give them names. Nobody's going to say, well, it was John and Michael transaction. All it needs is for you to use the same assumptions that market participants would use. So no specific participants to be identified. It assumes transactions taking place between independent, to arm's length. So, I mean, immediately one thinks from an audit perspective of making sure that you've got an up-to-date list of related parties or others who are in some way influential in the company. Knowledgeable, that might be apparent from the papers surrounding a transaction, that both parties understood what was the subject matter. Exactly where is that building? Able, and that's in terms of financial capability, technical feasibility, and willing, but they're not under some sort of pressure or duress to transact. And so in the light of the type of fair valuing that might have to be made, the standard then requires a disclosure of the hierarchy. Now, you will be familiar with this, all of you, I trust. It was first introduced in IFRS 7 in about 2005 or 6 time, probably about 2006, I think. It's now moved across to IFRS 13, unchanged, and in IFRS 13, it describes a so-called level 1 fair value estimate. Well, that should be an absolutely perfect zero risk estimate. It makes use of quoted prices, not even with some sort of adjustment, simply quoted prices lifted from, say, a dealer's screen. The pink newspaper, it's pink in most countries, I think. So a quoted price in an active market, always the best possible estimate of fair value. But of course, not all assets will have a quoted price in an active market. The asset that you're trying to value might be similar, but not the same as a quoted asset. In which case, it might be that you need to use a model with observable inputs to that model. So, for example, you might be trying to fair value a bond. You can identify the market interest rate for a, say, 3-year maturity bond. You can identify from Moody's or Standard & Poor the adjustment for a BB plus credit rating. And then all you need to do is just to estimate the future cash flows under that bond and discount it, and you'd have a pretty good level 2 estimate. The only risk really is you've gone and observed the wrong thing, or you have screwed up using your model. But I mean, frankly, a level 1 and a level 2 estimate, both of those are pretty low risk compared to an L3 estimate, where you're making use of a model and unverifiable inputs to that modeling process. For example, you might obtain a company's financial statement and you'd make your own estimate of whether their credit rating should be B, BB minus, BB plus, A minus, or whatever. Nobody can verify those inputs. So clearly there's a much higher risk involved in making L3 estimates for assets and liabilities. And remember, of course, that there are far less marketplaces for transfers of obligations than there are for the sale of cocoa, chocolate, coffee, metal, shares, bonds, and so on. The standard then discusses suitable valuation techniques and inputs to those valuation models. Now, there are 3 acceptable valuation techniques. Not all of them will be applicable all of the time. Typically, one of them especially is really only applicable to machinery and equipment and vehicles and buildings. You'll see why in a moment. So there are potentially 3 acceptable valuation techniques. One, described as a market approach. And what that does is to use observed prices and perhaps other data from marketplace transactions that might involve similar or ideally something that is almost identical in nature for asset or liability. So, for example, I'm sure many of you will be familiar with using a so-called PE ratio valuation approach for shares in an unquoted company. Consider that you're trying to estimate the fair value for a little private airline. Well, you might say, well, I can observe the PE ratio for a quoted airline, British Airways. Their PE ratio is, say, about 11. That was close to what it was recently, certainly. You might then make an adjustment to that for the lack of liquidity that your private company target has. So you might adjust it from 11 to, say, 9 or even 8. And then you measure the earnings per share of the target company and derive from that an estimate from an observed similar asset. So a market-based approach. And then secondly, there is the capitalization approach, sometimes called, the standard describes it as an income approach. And what this will involve is estimating future amounts, cash flows maybe, dividends possibly, profit after tax, EBIT, EBITDA, whatever. You estimate some future amounts. Probably you then stop at, say, year 5, and you might estimate a terminal value at the end of that. And then you discount all those amounts back to a today figure. And that's the approach in particular that lends itself to fair valuing liabilities, as you'll see with my example a bit later. Now, a third possible mechanism involves the concept of a replication. How much would it cost me to go out and replicate the service potential of an asset? Now, that's particularly relevant in the context, for example, of acquisition fair valuing, a business combination, where the target company brings to the table buildings, machinery, know-how, customer lists, and so on. And you ask yourself the question, how much would it cost me to build my own exact equivalent? Clearly, totally irrelevant approach to financial instruments. There is no building required to create a financial instrument. But a cost approach may well lend itself to buildings, machinery, vehicles, that sort of thing. In all cases, management should then select the appropriate method for which sufficient observable, external, verifiable data is available, and consistently then use that methodology thereafter. Now, there are some specific measurement issues that we need to touch on. And the first of those concerns the fair value of non-financial assets. Now, we've already seen a hint at this where we had, for example, items in markets A, B, C, where you had to take them to market. So clearly we're dealing with vehicles, items of inventory, animals, whatever. For non-financial assets, management must always try to identify the highest and best use that could be made of that asset by market participants. It's known as the HBU approach, highest and best use. And the highest and best use is hypothesized for transactions that are physically, technically feasible, that are legally permissible, and that are financially feasible. So let's have a very simple example. Company ABC Limited owns an investment property. Now that might be a block of flats with tenants, that might be a shopping mall, goodness only knows. But we're told that its value in its continuing existing use is 3.2 million. However, we're also told that in the context of a redevelopment, maybe it's a block of flats that could be redeveloped for a shopping mall, it's worth 3.4 million. ABC Limited has absolutely no plans to change the use of the property. What is the fair value? And I know that the inclination for some of you will be to take the lower figure because that's prudent. You're wrong. Having identified the highest and best use, fair value is therefore 3.4 million. Now, I suppose one would say in an ideal world, with perfect information and so on, every entity would always be doing the highest and best use for everything that they own. But that's not going to be the reality. So the standard requires that for non-financial items, we identify the HBU, the highest and best use. And that is irrespective of what the company might or might not be planning. The standard also comments in the context of share valuations, equity instruments, that premiums, for example, a premium would usually be estimated for the measurement of, say, a 60% shareholding, because it typically would grant control. And equally, perhaps, a discount where we're trying to identify the valuation of a non-controlling interest. And those premia and discounts are absolutely permitted by this standard if that is what market participants would weigh up when they are considering a transaction. It has to be consistent with the unit of account. So if you're trying to fair value non-controlling interest, then you wouldn't use the control premium valuation for it, obviously. The standard also adds that if there is a so-called blockage factor, and this would be the situation where the size of your shareholding relative to the market is quite considerable, and this happens typically for an underwriting bank, where after an initial public offering, the underwriting bank is left with a few million shares that the public didn't buy. And usually you'll find that the bank is not allowed to flood the market with those volumes. So a blockage factor, where the size of the holding relative to the volumes that the market might take, is entirely random. I mean, you know, finance people at no doubt Deutsche Bank and so on would try to convince you of some sort of deep theory, but no. If there is a quoted price, it must be used. Okay, without adjustment. There's basically no exception to that principle. Now that leads me to commenting on net positions, and this was the little amendment that was introduced to IFRS 13 effective from January 16, that a group position, so net assets or net liabilities, which is managed on that overall net exposure basis, can be measured as a single net position. Typically, it's where you have contracts for both buying and selling commodities, and you can take the net position for those contracts that are within scope of IAS 39 and IFRS 9. The standard also comments that for first ever recording, initial recognition, typically transaction price is a pretty good indicator of fair value. And we all know that, particularly for most financial instruments, initial recording, transaction price is used. But that's not always the case. And a classic example is intercompany lending. For example, where a parent lends interest-free to a subsidiary. And then fair value is not the money that was lent, but it's the present value of what will come back to you, discounting at a market rate. So in some cases, fair value, even for initial recording, has to be calculated, simply as that, rather than observed. And as we commented earlier, a significant decline in volume and activity in a particular market that's used as a reference point will require you to dig deeper in order to confirm whether or not observed transactions are, frankly, orderly, or are they relevant to the pricing exercise. Now, consider company X that has acquired a controlling interest in Y. Okay, so it's bought a subsidiary on the 30th of September. The acquisition papers indicate that the acquisition of Y included a brand, that's something else that will need to be fair valued, and the subject matter of what I'm looking at now, it also included the taking on the assumption of a decommissioning liability. So Y Limited has got some sort of facility, factory, whatever, that will have to be cleaned up at the end of its useful life. And we read that the end of the useful life is in 3 years' time. So immediately we know that the correct way to measure that liability will be a discounted figure. Okay, liabilities that are due in more than a year, 2, 3, 4, 5, and so on, are classically fair valued by discounting. We read that if X were able, well, we don't really know, but if they were able to transfer this problem to somebody else, well, of course, you know, these transactions do take place. I mean, particularly in the oil industry, there are those companies who specialize in decommissioning, and they will hope to be able to achieve their purpose at a lower cost than the price that they were paid. In other words, that's how they make their profit. So if X were able to transfer this liability to somebody else, then we're told that the following information would be used in that transaction. And we're told that somebody else would estimate the costs as perhaps 3.6 million. That's cost. Clearly, in transferring it, there has to be a markup. So we're told that a typical industry average markup for this sort of cleaning up activity is 15%. We're told that there is an inflation rate, constant for each year, of 3% per annum. We're told that there would be a somewhat arbitrary adjustment for risk associated with cash flow forecasting. That's 2%. We're also told that currently the risk-free interest rate, as illustrated typically by short-dated government bonds, British government bonds, one might say, decent government bonds, is 5%. And we're also told that the entity has a non-performance risk. It's the same as a credit risk. There is a risk that the entity in 3 years' time might say, we haven't got the money, we're not going to pay, or whatever. The entity is considering that it has a 1% non-performance risk. Now, my first question to you: what discount rate should be used? I mean, I'm sure we all accept that with a future cash flow for 3 years' time, to get a today estimate, we'll need to discount it in some way. And I'm telling you that the answer is on the screen. It's either 4, 5, or 6. Either the government risk-free rate in the middle, 5%, or it's the risk-free rate minus 1, an adjustment for the fact that the entity might say, I'm not going to pay, or I'm also giving you an alternative of 5% plus 1 as an adjustment for the entity's non-performance risk. So the answer is on that screen. In the middle is the government risk-free rate. Either side is a -1 and a +1 for the entity's own credit risk, the risk that the entity, Y in this case, or X for new owner, the risk that they might say, actually, we're not going to pay. We're not going to pay. So my question, which discount rate to use? And you'll see that I have opened a polling panel for you. Which discount rate? Okay, this is your liability. You're trying to estimate what the decommissioning liability is measured at fair value. Would you discount the cash flows at 5, being the risk-free rate, or would you discount them at 4 or 6, the risk-free rate minus my credit risk, my non-performance risk, or 5 plus 1? So you've had nearly 2.5 minutes. Okay, no calculations. The figures are very obvious, 4, 5, or 6. The question is, do we discount the liability at a risk-free rate, or something lower, or something higher, to reflect the risk that the entity in 3 years' time might say, well, actually, no, I'm not going to pay. Okay, we've got half of you have responded. I'm going to give you just another 15 seconds to see if anyone else wants to join the party. 5, 4, 3, 2, 1. Okay, not surprisingly, very few of you even had an idea. 3 of you did respond, and I'm afraid all 3 of you got it wrong. The correct answer is C. And you see, the way you've got to think about this is that if the entity is considering, even thinking about, we may not pay, my question is, does that make the fair value of the liability smaller or bigger? In other words, would you want to be discounting it by a higher interest rate or a lower interest rate? And of course, the answer is that if the entity is even thinking, I may not pay, then frankly, the fair value is 0. Or it's very, very small. How would you get a small fair value from discounting? Answer, by increasing the interest rate. So the correct answer is C. And if you want to look into this further, you'll find that in fact it is one of the examples in the implementation examples, page or paragraph 38E. It's example 9 in the standard itself that I've used as the basis for this question. So the entity measuring the liability adjusts the risk-free rate to reflect its risk of non-performance. In other words, the risk that it might say, no, not going to pay. And that would also include that it says, no money, credit risk. Therefore, the risk-free rate would need to be increased. It's a premium that is added to the risk-free rate. Now, of course, I guess some of you can anticipate what the final question is going to be. It is, so what is the fair value of this D